Morning, everyone. Thank you for coming here for our presentation. Today, we are going to talk about 5 topics, and each topic is responsible for one of our team members. Our purpose is developing a practical solution to the real-world situations. These 5 topics will be covered today, so let's get started. The first topic is the differences between accounting profits and the taxable profits. Accounting profit is measured as the differences between accounting revenues and accounting expense, which are determined in accordance with accounting standards, normally based on accrual accountings. Taxable profits is calculated as the differences between taxable revenues over taxation's deductions against those revenues. The key differences are followed below. Firstly, accounting profits consider depreciation as an expense, while taxable profits use tax deduction methods. Some expenses are considered an expense in accounting treatments, including goodwill impairments, entertainment outlays, and fines and penalties, while they are not deductibles in taxation treatments. Secondly, accounting profits, including interest revenues, are recognized when received, and the taxable profits only include cash receipts, while the interest expense are recognized as an expense when payables, and the taxable profits use cash payments, which are also applied in deferred development costs, receivables, accrual expense, and prepayment expense. Thirdly, bad and doubtful debts would be considered as expense when debt is doubtful, but they are written off as bad in taxation treatments. Besides, there are other differentiations in differences subjects. For examples, accounting profit recognizes losses, while taxable profits may defer recognitions of losses to future tax periods. In conclusions, accounting profit is a broad financial measures calculated based on accounting principles. Taxable profits is a narrow concept based on regulations and allowable deductions. I've finished my part, and let me hand it out to my teams and move to next topic. Thank you.
Moving on, I will briefly discuss the reasons why do we often observe a difference between the income tax expense recorded in financial statements and the actual income tax payable at the end of an accounting period. This distinction has significant implications for financial reporting and analysis. Let's begin with income tax expense. This term represents the amount of tax cost that is charged to the income statement. It's not just a simple calculations based on current profits. It encapsulates both the current tax expense, which is the immediate tax obligation, and deferred tax expense, which relates to future tax liabilities or benefits arising from temporary differences in the recognition of certain items. This figure is grounded in accounting principles, reflecting the company's estimation of its tax liability. Income tax payable, on the other hand, is the actual amount of tax that a company is obligated to pay to tax authorities, based on its taxable income as per tax laws. It's a more tangible figure seen on the company's balance sheet as a current liability. This is not an estimate, but a figure that represents the immediate tax obligations of the business. A primary reason for the discrepancy between these two figures lies in timing differences. The accrual basis of accounting allows for the recognition of revenues and expenses when they occur, not necessarily when the cash is exchanged. This method can lead to a mismatch with the tax reporting system, which may use different criteria for recognizing transactions. For instance, the method used for depreciating assets can differ between accounting and tax, leading to variations in reported income. Deferred tax assets and liabilities further complicates this. They originate from temporary differences between the carrying amount of an asset or liability and its tax base. For example, if you depreciate an asset, differently for an accounting purposes than for tax purposes. This creates a timing differences that results in deferred tax. Another contributing factor is permanent differences, which arise from items that are either only recorded in financial accounting or only in tax accounting, such as tax-exempt income or non-deductible expenses. While income tax expense and income tax payable are interconnected, they often differ due to the distinct principles that govern financial accounting and tax accounting. Understanding this difference is essential for accurate financial reporting and making informed business decisions.
Thank you very much. Now we are going to talk about the situation. Why would a profitable company potentially not have any income tax payable to the relevant taxation authority? There can be multiple reasons why a profitable company not having any income tax payable at all. The first one is that the company may have substantive amount of depreciation for current year. Depending on their depreciation method used, it can generate huge depreciation expense for current year, which is tax deductible. For instance, manufacturing company like CSR has to provide materials for buildings as one of its main businesses. Because of that, they must rely on plant and equipment heavily, which can result in significant depreciation annually. Under extreme circumstance, if they have a hard year or have pure bad luck, such as experiencing COVID-19 pandemic, lower than expected profits can be foreseen. And it may be the case that income tax expense goes higher than tax payable and also outpaces the profit, enabling no income tax payable for the year. The second point here is a timing difference for recognizing revenue and expense when preparing financials for accounting purpose and for tax purpose. Construction companies such as Transurban may have to recognize revenue based on the work in progress upon completion as part of this accounting standard requirement. However, large capital expenditure is expected at the beginning of the construction project, which contributes to the first year tax deductible. Also bring to the attention that the company can have deferred tax asset from previous financial years. General Electric was having huge financial losses around 2017, and as in their financial statements in 2017 and 2018, we can see substantive amount of deferred tax asset. In later profitable years, those losses offset the taxable income, leading to the scenario where income tax expense was reported, but no payable was occurred. Last but not least, for this situation, potentially tax beneficial policies from the local council, government, or exemptions can address on these phenomenon so that even if a company is having accounting profit for current year, let's say it is a green energy company, they might have tax incentives for excellent sustainable development from the local council, and they will have the chance of paying very limited tax and even no tax payable at all. This is the end of this situation. Now we will go to the next one. Thank you.
Hi everyone. Now we're coming to question number 4. Would incurring a loss for tax purpose lead to the recognition of tax-related asset in the financial statements, and why is that so? So the income tax paid in certain year frequently varies from the income tax expenditure disclosed in the statement of profit and loss and other comprehensive income. The existence of this difference may be attributed to the application of deferred tax accounting, which is in accordance with the rules of accrual accounting when it comes to the recognition of tax-related asset in the event of incurring a loss for tax purposes. Certain principles are applicable. So firstly, is the deferred tax asset. It can be recognized by a firm in the event of incurring a tax loss. This asset represents the tax advantage derived from a loss which may be utilized to decrease taxable income and hence lowering the amount of tax owed in subsequent years. Secondly, the future taxable revenue. The crucial factor in identifying a deferred tax asset is the anticipation of future taxable revenue that can be offset by the tax loss. If the firm anticipates generating future profits, it has the opportunity to utilize these revenues to balance any tax losses incurred, resulting in potential tax savings. And last but not least, recoverability necessitates the assessment of this recoverability necessitates the company's evaluation of the likelihood of generating enough taxable income, taxable profit in the forthcoming periods to effectively utilize the tax loss. This evaluation entails the exercise of discernment and may rely on projections and other pertinent data. The recording of a deferred tax asset in financial accounts in Australia may arise when loss is incurred for tax purposes. Given that there exists a reasonable anticipation of future taxable income that may be used to offset these losses, this is consistent with the accrual foundation of accounting, which entails recognizing revenue and costs when they are generated or spent, rather than when the cash is received or paid. So that is all for my part. Moving on to question number 5.
So for question 5, when a new tax rate is enacted in Australia, the new tax rate should be applied in the calculation of the current tax liability and adjustment to deferred tax accounts during the year. First of all deferred tax liabilities must be recognized. Therefore, the action could be reassessing deferred tax assets and liabilities. This is due to temporary differences between the tax base of assets and liabilities and their carrying amounts in the financial statements. When tax rates change, the value of this deferred tax will also change because they are measured using the tax rates that are expected to apply when the temporary differences reverse. The current tax expense in the income statement must be recalculated based on the new tax rate to ensure that the current year's tax expense accurately reflects the current tax liability according to the revised rates. Then the financial statement should be clearly disclose the impact of the tax rate change. General adjustments must be passed to increase or reduce the carrying amount of deferred tax assets and liabilities to reflect the new value of future taxable or deductible amounts. Failing to adjust for the changes will result in deferred tax assets and liabilities being overstated or understated with respect to the reversal of tax effects. Moreover, change in tax rates might impact the effectiveness of existing tax planning strategy. Companies may need to revise their strategies to optimize their tax positions under the new rates. And it's important to communicate with shareholders about how the changing tax rates impacts the company's financial position and performance. In addition, accounting system and processes will need to update to incorporate the new tax rates. This ensures accurate calculation and reporting of tax-related figures in financial statements. In summary, we have explored the complexities of accounting and taxable profits, examined various scenarios impacting a company's tax liabilities, and discussed the effects of tax rate changes on financial statements. And here is the references. Thank you for your attention.